Welcome to the Every Biz Daily podcast. Okay, let's unpack this. Today, we're taking a deep dive into the recent audited annual results for Dis-Chem pharmacies. This is for the 12 months ended 28 February 2025. We're going to sift through the official announcement, really try to figure out what drove their performance last year, and maybe more importantly, what the company's planning next, specifically with you in mind.
That's right. These results, they give us a pretty clear snapshot, how the business actually performed and highlights the key areas they're focusing on going forward.
Absolutely. So let's start with maybe the big picture numbers. The report shows group revenue grew by a solid 8.0%, hitting $39.2 billion for the year. That's a decent top-line increase.
It is. But here's where it gets, really interesting, as you said. The earnings per share EPS and headline earnings per share HEPS, they saw much stronger growth.
Okay.
Both were up a remarkable 20.0%. That takes EPS to 137.6 cents and HEPS to 137.5 cents.
Wow, 20%.
Yeah, that 20% jump in earnings, that's really the headline here, I think.
Okay, a 20% increase is definitely impressive, especially when you compare it to that 8% revenue growth. So what was the key factor there? What drove that faster earnings growth?
Well, the results point very clearly to effective cost management. That seems to be the primary engine.
Okay.
Specifically, they call out savings within payroll costs. And they attribute this success to rolling out something called Staffing Framework 1.0.
Ah, right.
And this initiative, it helped their operating profit grow even faster than revenue, up 18.3%.
So classic operating leverage then.
Exactly. Revenue grows, costs grow slower, and bam, profitability gets that disproportionate boost.
Okay, so getting smarter about staffing really flowed straight to the bottom line.
Got
it. Now, I think I saw something about an adjusted earnings figure, too.
Correct, yeah. Good catch. If you actually strip out a one-off gain from a property deal, I think of their Midrand warehouse, the underlying EPS and HEPS growth were still pretty robust, 12.2% and 12.3% respectively. So yes, the 20% includes a bit of a one-off benefit, but the core business, the actual operations, still delivered very strong double-digit earnings growth.
Okay, that's clear. Let's maybe look briefly at the different parts of the business then. How did retail and wholesale stack up?
Sure. So retail revenue, that grew by 5.9%. If you look at comparable stores, the ones open for the whole year, they saw a 4.1% increase.
Okay.
And they kept expanding their footprint, adding 20 new retail pharmacies, though they did close the...
Net gain
on pharmacies, yes. But they did have a net reduction of 9 baby stores. So they ended the year with 285 pharmacies and 45 baby stores.
Interesting. And wholesale.
Wholesale actually grew faster, up 9.9%. And what's really notable within wholesale, there's external revenue.
External revenue.
Sales to independent pharmacies and also to their local choice franchises. That part jumped by a significant 22.1%.
Wow. Okay.
Yeah, that external wholesale channel, it's showing some serious momentum.
That external growth is definitely a bright spot. And of course, for investors tracking the company, the dividend is always a key number.
It is, absolutely. So the final dividend declared is 27.85 cents per share.
And how does that compare?
That's a healthy 23.8% increase from the previous year's final dividend. And it lines up with their stated policy paying out 40% of headline earnings.
Okay.
The total dividend for the whole year comes to 54.83 cents. And for anyone interested, the key dates. Last day to trade come dividend is June 17th, 2025. Payment date is June 23, 2025.
Good details. Thanks. Looking ahead now, what does the outlook tell us? How's the current financial year starting off?
Well, the report does note that for the first 3 months of this new year, so March, April, May 2025, group revenue growth has continued at a pretty steady 8.6%.
Okay, so similar pace to last year. The growth trajectory seems to be holding.
Yeah, it looks like it.
And what about their big plans? The strategic priorities for this year, FY 2026. What are the main initiatives they're focusing on?
They've got a pretty ambitious slate, actually. Physically, they're planning a significant expansion, targeting 39 new retail pharmacy stores.
39, wow.
Yeah, quite a number. Operationally, they're moving to what they call Staffing Framework 2.0, presumably building on the success of 1.0.
More efficiency gains, you'd think.
That seems to be the goal. They also have a major target, quite specific, to unlock our $500 million in working capital.
R500 million. What does that usually involve? Inventory? Payments?
Typically, yeah. Optimizing inventory levels, managing supplier payments, maybe getting cash from customers faster, basically freeing up cash tied up in the day-to-day operations.
And that freed up cash presumably helps fund things like those 39 new stores?
Exactly. It reduces the need for external funding. And alongside that physical growth and operational efficiency, there's a really strong focus on the customer experience and the digital side.
Okay.
They talk about reimagining their online channels, evolving promotions and loyalty, and building customer engagement around an ecosystem strategy.
Ecosystem, connecting different services.
That's the idea. Connecting various health and wellness services around the core pharmacy. And to support all this, they're setting up an innovation hub. They call it X, Bigley Labs.
X Bigley Labs. Interesting name.
It is. And the focus there seems to be on using data much more effectively for decision-making, data-led decisions.
Wow, okay. That's a really comprehensive approach then, expanding stores, refining operations, and building out that whole digital and customer ecosystem. So bringing it all together, what does this mean for someone watching Dis-Chem? What's the main takeaway?
Well, I think it shows a company that really successfully used operational levers, particularly controlling those staff costs, to significantly boost profitability last year, even outpacing their solid revenue growth.
Right.
They're rewarding shareholders with that strong dividend hike, and they're clearly setting the stage for more growth. Aggressive fiscal expansion, plus significant investment in digital and customer strategy.
It certainly raises an interesting question, though. We know the general consumer is expected to remain, well, pretty constrained in the current economy.
Definitely a headwind.
So how might Dis-Chem's really ambitious plan, opening 39 new stores, targeting that huge $500 million working capital unlock, how might that actually play out in the year ahead, given those consumer pressures? Something for you to consider as you look at the retail and healthcare landscape.